makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London with the conversations that matter. And here's what's coming up on today's program. Tesla shines as it speeds up the plan for cheaper cars while investors overlook a big miss on earnings. Carrying shares tumble after the luxury group warns profit will plunge as a crisis at its biggest brand, Gucci, deepens. Plus, President Biden says fresh U.S. military aid will start flowing to Ukraine within days after the Senate passes a long-delayed aid package. Now, good morning, everyone. First thing is first, we have some Germany April Ifo Business Confidence Index, a bit better than expected, 89.4. The estimate was 88.8. Now, the other big story, of course, of the day is some of the European stock rally that we've seen yesterday, following, faltering a touch, actually. We've had some pretty mixed earnings. And this is, for example, from the banking world and the luxury sector, offset some of the further gains for technology stocks. So technology is doing quite well. We've had some U.S. tech giants, certainly yesterday. We've seen weakness in measures of business activity for the world's largest economy, but that's also keeping alive forecasts for Fed policy easing this year. So I have to say the whole cross-asset is a little bit complex because there's always nuances to what the Fed does. The 10-year Treasury yield ticking higher, a gauge of the dollar was actually steady, but there was also this two-year auction, which we look at very closely here on the Pulse, and that's actually went okay. 493.93 is where we're at, and you can see euro dollar 106.91. Now that Ifo business confidence actually coming in a touch better than expected. 89.4 instead of the estimate 88.8. And then the big story among some of the corporates and some of the earnings is Tesla. Pre-market, we're just getting that, of course, open, and it's gaining some 12% pre-market. We did also have a great Bloomberg story on Monday that really hit the nail on the head on exactly what we thought, and our reporters on the ground thought Tesla would do. So we had much more of an insight from Elon Musk yesterday as they reported earnings. So for actually a lot more on Tesla, getting some 12%. Let's get straight to our auto czar. He's Craig Trudell. He oversees automakers across the globe for us. So, Craig, thank you so much for joining us. First of all, I mean, Bloomberg and, under your team and your leadership basically did this wonderful story, The Big Take, that kind of had understood that what Elon Musk wanted to try and do is get some really cool, engines and put them in their best-selling models. Is that what we found out yesterday? Yeah, so to kind of go back, this company got everybody excited about this idea of a $25,000 car late next year. Yeah. Then kind of freaked everybody out by giving every indication that that was actually not the plan. Last night, Musk gave every indication that Ed Ludlow and Dana Hull's reporting that what they're going to do is take some of the development work toward what was going to be that $25,000 car and apply it to their existing lineup. And that means getting cheaper cars to market faster, de-risking that plan a little bit. It's less CapEx intensive. And, whenever you bring entirely new cars to market, it's a high-risk proposition. It means you're probably going to have to take some downtime. He gave every indication last night that they're going to take this sort of go-between strategy to get something to market, maybe even as soon as late this year. And, Craig, the fact is that actually analysts like the fact that Tesla is trying to accelerate the launch of this less expensive cars, right, because they really disappointed in the previous quarter. Let's listen to what Elon Musk had to say on the call with analysts.
We've updated our future vehicle lineup to accelerate the launch of new models ahead of previously mentioned start of production in the second half of 2025. So we expect it to be more like the early 2025, if not late this year. These new vehicles, including more affordable models, will use aspects of the next generation platform, as well as aspects of our current platforms, and will be able to be produced on the same manufacturing lines as our current vehicle lineup.
Again, on the back of that, so Tesla's up quite significantly, pre-market because of the speedier rollout. Are you worried that he disappoints on the timing of it?
I think we do have to be really careful in that Elon time is not always actual time, right? So he often sort of overpromises and underdelivers. But I do think that, it does make some sense after the absolute battering that the stock has taken, particularly just in the last few weeks, that this plan to bring cheaper cars to market, gives people a little bit more confidence with this idea of, okay, maybe this is a company that can grow again. And I think his outlook for the year is referring to the idea that he does expect to sell more electric cars this year than last year, also put people at ease because people started to have real doubts after the rough first quarter that they had.
So, Craig, what are you watching for next? Again, this lower price car could certainly help sales. Do you watch for the first sale or actually the first making of the car?
I think we need indications that optimism about sales going up this year is actually warranted because for all of the happy talk and the excitement about last night's call, the earnings were abysmal. They had more than $2.5 billion in negative free cash flow. That's the most ever. Revenue came short of estimates. Earnings came short of estimates. So under the hood, the company is not performing well.
Okay, Craig, thank you so much. Always interesting, Tesla. There's always some surprise around the corner. Pre-market getting some 12% for Tesla. Bloomberg's Craig Trudell there. Now, we also had some latest German Ifo Business Confidence Index rising more than expected, than economists had expected in April. Now, I'm delighted to be joined by Clemens Fuest. He's the president of the Ifo Institute. Mr. Fuest, as always, thank you so much for talking to us. Now, the Bundesbank actually thinks that the economy probably grew in the first quarter. Germany, once again, would be dodging a recession in that scenario. Are you confident that the turnaround is now here for good?
Well, I think the first quarter didn't go great, but what we now see is an improvement, yes. And in a way, it's a divided improvement. It's mostly coming from services. We also see good data from retail. In industry, in contrast, the situation is bad and continues to be bad. So manufacturing companies are telling us they are lacking orders. Construction is also flat, not going well. But at least we have this positive impact of more consumption, and that helps.
Yeah, so I was going to say, actually, consumers, I guess, have been for a long time expected to drive the recovery, but have been quite hesitant. With this renewed optimism that you have on consumption, are you confident that that will pick up, that that's really turned a corner?
Well, it looks like it's picking up. We had expected it to pick up earlier, but this is something that may lead us to growth in the second quarter, I would say. I think for the first quarter, that won't help anymore, but for the second quarter, I'm more optimistic. And it's consumers that are driving this. Incomes are rising more quickly than inflation because inflation is going down. So what we've been waiting for, in a way, it looks like it's coming.
There's quite a difference between services and manufacturing. So manufacturing weak, services doing quite well. Do you expect to catch up soon?
At some point, yes, but we don't see this catch up. We see an improving worldwide economy, but this doesn't seem to reach German manufacturing, which is puzzling in a way. Of course, there are issues in Germany, high taxes, concerns about protectionism. A lot of German companies are investing, but they are investing abroad, not in Germany, because they want to be present in markets and maybe jump over protectionism and tariffs and produce closer to consumers. This is no good news for Germany as a location for manufacturing firms, and we don't see the recovery there yet. It'll hopefully be coming, but that may take some time.
Mr. Fuest, overall, Germany is still performing, much worse, or at least worse than other European countries. Is there still a chance that this economy catches up?
I think what we're seeing at the moment confirms the forecasts, which are saying the growth will be weak in Germany, but at least it won't be negative. So this is the stabilization we expected. It's not a complete recovery. But at least it's a start.
What's your take on geopolitics right now? I know it's the impossible question to answer, but how much will that weigh on German growth?
I think it's one of the factors really weighing on German growth because Germany is an exporter and exporting is getting more difficult. And that's why we see companies investing more in what used to be the destination of German exports. So that's investment in the US. That really is an issue. At the same time, Germany is trying, despite the tensions, Germany is trying to maintain trade relations. Chancellor Scholz just traveled to China and there were a lot of people from companies, from industry accompanying him. He's been criticized for that because people say we need to de-risk in China, but at the same time, I think it does make sense for Germany to try and maintain trade relations, and that's what's going on. Unfortunately, new trade agreements, for instance, with Mercosur, are slow, and that's another problem for the German economy. Germany has a strong interest to come to new trade agreements, and that's going very slow at the EU level. So what will happen there, whether we in the end do achieve these trade agreements, will be very important, especially for German companies.
And Mr. Fuest, how much do you worry about inflation picking up again? So the ECB not cutting rates and that weighing on the economy?
I don't expect the ECB to maintain rates. I really expect them to cut rates. Yes, there may be pressures coming from the service sector because wages are rising, but at the same time, the economy overall in the Eurozone is not strong enough, in my view, to produce another increase in inflation. That would be different if there was another crisis in the Middle East, for instance, and oil prices were rising. But as long as that doesn't happen, I think there is no danger that the ECB will call off the interest rate cuts everybody's expecting. So I think that will come, and I do think inflation will continue to go down.
Okay, Mr. Fuest, thank you so much for joining us today. That was Clemens Fuest, the president of the Ifo Institute. Now, coming up, we also take a closer look at how mega cap earnings are driving market sentiment with Goldman Sachs senior strategist Sharon Bell. That's next, and this is Bloomberg. Well, European stocks steady as a rally in tech stocks was offset by a post-earnings pullback in carrying and luxury stocks. Let's get more from Goldman Sachs senior strategist Sharon Bell. Sharon, thank you so much for joining us. I mean, you're always so good at putting together all these different strands of some of the market pressures, some of what will support valuations. A lot of it is now in the companies, but we can't also forget the macro.
Yeah.
So your research at the moment is focusing really on different valuations depending on the region you're in.
Yeah, I mean, we feel that the gap in valuation between the US and Europe, which has always existed, I mean, the US equity market's more expensive, it's performed extremely well in the last decade, really, very consistently, but the gap in valuation between the two is very large at the moment. And as we heard just now, the Ifo survey has been a little bit better in Germany. Some of that data is improving very, very modestly, and that should help not close the gap, far from it, but certainly narrow it a little bit.
But I was looking at some research, like if you look at S&P, earnings expectations, they just keep on rising. Like, is there an end to how much some of these companies can grow?
I think that US is growing fast. I totally agree. And you see that for the economy. You're probably going to get first quarter GDP around 3%. So fast pace of growth. Whereas in Europe, we'll be lucky to get above zero. Hopefully it will be above zero in the first quarter. But I guess it's a case of what's in the price. And already US companies are highly valued for that growth. And I would say if you look at earnings growth year on year, it is decelerating compared to where we were at the very end of last year for US stocks.
Do you worry that the markets are discounting any kind of geopolitics event because of inflation that could even force ECB not to, or do one cut and then be done?
Yes, I mean, I think everyone has pushed out their expectations for when the Fed might start cutting rates. We have ourselves a little bit, and there is of course a risk that they don't even cut this year. Some people have even discussed a hike, not our view. So, of course, I think from an equity perspective, it's not for all bad reasons. It's because growth has been good, largely, but also inflation has been a bit sticky. And to your point, as well as inflation being sticky because of higher wages and higher services spend, etc., you've also got the additional issue that if commodity prices have been rising because of geopolitical risk or supply constraints, that gives us another kick to inflation, which won't be helpful either. But I feel in Europe, the disinflationary trend from very low growth that we've had in the last few quarters is still very much there. Gas prices have risen, but they're still so far from their peak. As storage levels are good, etc. Europe shouldn't have the crisis that it did last time.
I mean, there's a couple of market movements that, again, we're trying to get our head around, like what's happening with gold, which is just behaving differently to everything it's done in the past. Is there something, I mean, is this a play on liquidity? Is it, something else in the market?
I mean, we think that there's a lot of reasons why people want to diversify their exposure, let's say, and gold is a nice asset to diversify to. You mentioned geopolitical risk, which is almost top of mind for every investor that I speak to. It's one of the first things they talk about. So you're worried about geopolitical risk, gold is seen as a bit of a hedge. So maybe commodities and other assets like the dollar, which has also been doing well. So gold, I think, is one beneficiary of that. But also, I think you've started to see more central bank buying of gold. You've seen more buying generally of gold as people are worried about maybe sanctions, maybe geopolitical risk, maybe too much exposure to the dollar. Lots of reasons, I think, that people wanted to diversify away from just one, I want to say risk-free asset, but one asset provides you a little bit of a hedge against some of these global risks.
Amongst your notes, and I love some of the strategy, reports that you put out. So you say, buyback bonanza, yields are returning, and it's very clear that it's bank and some of the energy stocks that have been giving back dividends. I mean, is this, how do you play those sectors that just have been very, very good to investors?
Well, this is in some ways this argument again of the gap between the US and Europe. Yeah. Many European companies are super cheap. They are super cheap, so much so that these companies making good earnings, like the energy stocks or the banks, are saying, we're making good earnings, good cash flow, we are super cheap, we don't have a very stretched balance sheet. You know what we're going to do? We're going to buy back shares. They've been buying back shares, and actually our basket of companies which buy back shares the most has been doing super well. So I do think I think this... Lots of people have been concentrated in, say, the Magnificent Seven, the big cap tech stocks in the US, and they have done really well, and they've got the growth story, as you point out. But I think there are other stories out there too, including the fact that European companies for many years didn't do buybacks, and now saying, actually, with this excess cash, we know our stock is cheap, we're going to buy back our shares.
I mean, luxury did extremely well in Europe, and you have some big players, and now it's getting I guess, repriced. I mean, is this a wider concern for the sector?
I would say with luxury that it's been very mixed. There have been some real losers there. There have been companies that maybe they're losing market share, is my feel, rather than you're seeing a collapse in demand generally for luxury. I mean, we know the wealth of the highest income, wealthiest globally has actually been reasonably strong over this last year. You see this in asset prices doing very well, as you point out. So to us, you're not seeing luxury demand collapse. It's more reshaping of who's doing well and who's doing less well. Also, the Chinese traveller is definitely around. They're travelling again, and they buy lots of luxury products. You're not necessarily seeing them buy in China itself, but you can see them buy in the rest of Asia in particular. So to us, actually, it's more that rather than a wholesale decline in luxury demand.
So interesting, Sharon. Thanks so much. Sharon Bell from Goldman Sachs stays with us, and we'll talk a little bit maybe about dollar dynamics next. This is Bloomberg. Welcome back to The Pulse, everyone. Now we're back with Sharon Bell, Goldman Sachs senior strategist. Sharon, thank you so much for sticking around. We're talking about some of the earnings, some of where you see the biggest value in terms of industry groups. Now, how problematic is stronger dollar for the rest of the world?
I think for Europe, if I'm thinking about European equities and earnings, actually the stronger dollar is a good thing. A lot of European companies are dollar earners. And a stronger dollar means when they translate that back into euros or sterling, actually, it looks quite good. So a stronger dollar is definitely not unhealthy for European companies' earnings. If anything, I would see it as a bit of a tailwind for them. And that being said, you've got to also think about the reasons for the stronger dollar. To the extent that it's stronger US economic growth, that's fine, obviously, for the rest of the world, because you benefit from that stronger growth. Lots of companies sell into the US. But to the extent the stronger dollar is because of geopolitical risks or some other constraint, then absolutely that's not such a good thing for the rest of the world. And I think it's a little bit mixed at the moment.
Okay, so I mean, I know it's impossible to quantify, but is it like 20% because of geopolitics and the rest because of the stronger economy? Because there's also a worry that actually the US economy is overheating.
Yeah, I guess also that pushing out of the Fed, so rate expectations as well, all of those things pushing up the dollar. So it's a little bit of a mixed bag, but on balance, and particularly for earnings, I would say for European companies as well, that reporting euros and sterling is actually going to be a bit of a tailwind.
Sharon, I have a million questions on AI, what will drive, our economies, on the price of oil, on China. What's the question that you think is more important right now that investors need to ask themselves?
Oh, that's a great question. Look, I think, again, if I'm thinking about European equities, I would say whether we actually genuinely get a turn in growth. And I link this back to the conversation you just had on the Ifo data. Yeah. We have seen that improve, which is fantastic. And the PMIs that we had yesterday also showed improvement, but they were mixed. Yeah. The manufacturing side of the economy is still super weak. The services and consumer side, absolutely clear from the data that is improving as inflation comes down and real incomes improve and employment is good. So that's great. But will we see that movement up in manufacturing broaden out? Yes, the US economy has been strong, but most other places have been weak. So broadening of growth and particularly toward manufacturing is important.
So good. Thank you so much, Sharon. Sharon Bell, there, Goldman Sachs senior strategist. Now, coming up, President Biden is expected to sign a long-delayed aid package into law today, clearing the way for resumed weapons shipments to Ukraine, actually this week. Details next, and this is Bloomberg. Tesla soars pre-market as it speeds up the plan for cheaper cars. Investors overlook a big miss on earnings. Well, carrying shares tumble after the luxury group warns profit will plunge as a crisis at its biggest brand, Gucci, deepens. Plus, President Biden says fresh U.S. military aid will start flowing to Ukraine within days after the Senate passes a long-delayed aid package. Well, good morning, everyone. Welcome to The Pulse. I'm Francine Lacqua here in London. Now, we had a terrific debrief by Craig Trudell on exactly what's going on in Tesla. I would suggest everyone go back and read also our big take from Monday. That was kind of spot on what Elon Musk was trying to do. Now, Tesla soaring almost 11% pre-market after pledging to speed up the launch of their more affordable models. Again, the first quarter profit and sales actually missed, but the EV maker plans to release the cheaper cars as soon as this year. And that's, frankly, well ahead of its previous late 2025 timing. This actually gave a lot of optimism to analysts out there. You can see Tesla gaining 10.3%. Now, a couple of other things we're watching out for is some of the banks. We were hearing there from Sharon Bell, of course, from Goldman Sachs, that this is one of the things that they're looking for and they're looking at in how much banks are also giving back to shareholders. So if you look at the equity complex here in Europe, it's definitely banks and energy that have been quite cash rich and have been able to give back probably the most. Now, some breaking news we have also from UBS just coming out on the Bloomberg terminal. UBS saying they are seriously concerned about some of the Swiss capital proposals. Now, we have been bringing you up to date with the fact that the S&B has raised the requirement reserves for banks to reduce payouts. Now, this happened a couple of days ago, so this is actually the first time that UBS is coming out with a statement on these new capital proposals saying that they're seriously concern. So we'll continue looking at this very, very closely. It was just a couple of days ago that the S&B said they would require banks to hold more money at the institution. Again, a move that will cut how much interest it actually pays to them. On to politics, and the U.S. President Joe Biden is expected to sign a long-delayed $95 billion emergency aid package for Ukraine, Israel, and Taiwan into law as soon as today. It clears the way for resumed shipments of weapons to Ukraine this week. Now let's get more from our Bloomberg Markets Today anchor, Kriti Gupta. So, Kriti, I mean, this was, very welcome news, certainly from Europe. What can Ukraine expect in terms of actual shipments?
Yeah, let's talk about kind of where the money actually goes here. A lot of this is air defense systems, and this is really important in terms of drone warfare. We cover that quite a bit in terms of what's going on in terms of ground day-to-day movements between Ukrainian and Russian forces. So about $14 billion out of the 61 total is going just those U.S. defense systems. So the idea here simply we have the machinery that detects those attacks, radar systems, etc. Then you have about $13 billion going to actual stockpile replenishments. That's ammunition, that's firearms, etc. $7 billion for about U.S. operations there. And then I think the key part here is the $9.5 billion in forgivable loans. And this is crucial because this was originally a President Trump kind of idea that was then tacked onto this bill. The idea here simply being that ultimately this is a more economic assistance as opposed to defense assistance that would go in other places of the Ukrainian economy. The assumption here is that if President Biden comes to a second term, he will forgive those loans. If President Trump does, they will not.
So there was quite a lot in the bill, including sanctions against, Iran. What are the implications of those?
Yeah, the broader sanctions are interesting here because there have been sanctions on Iran for a very long time. And a lot of people have said it's not about the sanctions, it's about the enforcement of the sanctions. And that's where the nitty gritty of the fine print really comes in handy, because this isn't just oil or ports or vessels or even kind of the refineries that Iran operates. It's the infrastructure, the financial infrastructure, a lot of which is kind of built and operated by the Chinese, that is getting targeted. Now, in terms of the actual oil price here, I think that's what everyone wants to hear. It's that geopolitical premium. People are saying about $2 to $3 a barrel. That's the call, at least from Eurasia Group, added on to about $90 a barrel if, big if there, that stricter enforcement actually comes through. Javier Blosser, Bloomberg Opinion, saying that's been an issue for a while, and he'd be surprised if it actually did.
And then TikTok feeling the fury of the U.S.
Yes, even more China's read-through. Again, you can kind of see a theme in all of this show up. The divestiture has been on the kind of playbook and on the agenda for a very long time. Now that it's getting signed into law, there's a very long legal battle ahead of us. Remember the last couple of years, we've had TikTok removed from the App Store, removed from the Android, then brought back on because of those kind of competition questions as well. Now TikTok, ByteDance by extension, really gearing up for a long legal battle, kind of putting their boxing gloves on, saying this is not only unfair to Chinese businesses, but ultimately unconstitutional because so many people, even Americans, have been lobbying for easier access on TikTok, given it's a way to actually make money for things like influencers, for example.
Yeah, it was, such a great roundup of a very important bill. Thank you so much, Kriti Gupta, there at Bloomberg Markets Today anchor. Now, this was supposed to be the year that Vietnam reaped the benefits from its largest natural gas discovery in the South China Sea. On the other side of the disputed waters, the Philippines has long eyed the energy riches off its northern coast as a way to reduce its reliance on imported gas and oil. But neither country has benefited as Beijing continues to claim the territory and tensions rise.
These two ships are from the Chinese Coast Guard. And the ship they're targeting with high-powered water cannons is a Philippine supply vessel.
We've been here for almost 3 hours, and the situation has gotten more tense.
An international court says the Philippines has the right to extract resources in these waters.
Since the threat has grown, we must do more to defend our territory.
China doesn't see it that way.
面对非方船只的强行冲闯，中国海警不得不采取必要的执法措施。
It's the sixth time in 8 months this kind of incident has happened, and it's a growing problem for the world. The U.S. and the Philippines have a mutual defense treaty dating back to 1951, and the circumstances that may trigger U.S. involvement have become more clear recently.
Southeast Asian leaders are anxious over the prospect of a war between the U.S. and China, two partners that they depend on dearly, whether it be over Taiwan or in the South China Sea.
Second Thomas Shoal is the most dangerous flashpoint today. This is truly a crisis waiting to happen.
China and the Philippines have wrangled over control of these waters for decades. But in the past year, tensions are close to the highest they've ever been.
Well, Bloomberg Originals are taking a closer look at the escalating tensions in the South China Sea. It's also the topic of today's Big Take. Now, the South China Sea and global defense more broadly is high on the agenda as the U.S. Secretary of State, Antony Blinken, travels to China today. So let's bring in Bloomberg's news director for the EMEA region, Rosalind Matheson. Ros, I'm really happy to speak to you today because there's a lot of big but also little concerns around the world, and I don't know whether there's a common thread. Is the common thread just more risk appetite for geopolitics, or is it China trying to influence corners that in the past they hadn't?
Well, the common thread really is that we're moving from a world where the US was the single dominant power globally to a multipolar world where you've got not just China but Russia, you've got middle powers in the Middle East rising, you've even got countries like South Africa suddenly more assertive in foreign policy. And so it's a long-running trend that we're seeing where the US arguably is retrenching in certain parts of the world, and that's bringing tensions, as is the case between the US and China particularly. And the tensions in the South China Sea, they've been bubbling for decades. decades. But what's happened is that China has really had the advantage, and now we're seeing that bear fruit. So many, many years ago, China started repurposing these reefs, these shoals in the South China Sea, and turning them essentially into military bases using their Coast Guard. They've been using their Coast Guard to scuffle with the Vietnamese and the Philippine military for years now, but it's really escalating to the point where they're stopping these countries around energy resources in the region. They're sort of essentially changing the status quo in the South China Sea. And that's part of the broader thing that we're seeing globally, again, with different countries emerging as powers and the US, some would argue, in decline.
So, Roz, when you look at non-friendly U.S. countries, so I'm thinking of Iran, Russia, China, are they biding their time in case Trump comes in the White House, or do they have a window of opportunity to kind of, inflict, chaos or doubts from now until the U.S. election?
Well, you can see on the part of the U.S. administration that Joe Biden is trying to bake stuff in now in terms of law and behaviour, just in case it is another Donald Trump administration. You can see countries like in Europe and elsewhere preparing for that eventuality. You talk about the future of NATO, for example, and that's going to be very uncertain if Donald Trump comes back to the White House. But you can also see that China likes to play both the short and the long game. So you've got a short game going, which is to get themselves in the best position for a future US presidency, be it Joe Biden again or Donald Trump. But China, like Russia and others, arguably play the long game too. China's thinking in a 10, 20, 30-year horizon about where they see themselves economically, strategically, geostrategically in the region. And they're looking through the US administrations in a way beyond who's just in power in that minute, what's their long-term goal. And that's the way the US, in turn, probably needs to be viewing its behaviour with China.
What's your take on Ukraine right now? With this extra help and the extra bill, even if we have help that comes this week, can they really longer-term win the war?
Well, that's the big question. I mean, obviously, any military aid is useful and important, however late it comes, and some is really needed, from everything from ammunition to artillery to air defence, and that's also coming. It could come pretty quickly at this point, but it's at a point where Ukraine needs to regain momentum, and that's always difficult when you're behind and you need to recover, and Russia's got the momentum at the moment. And then beyond this aid package, anything further is going to be very, very difficult given the political climate in the US. So if this was hard enough, imagine further big packages getting stuck in Congress forever. And Donald Trump, again, if he wins the election, he's made clear he doesn't see the need to continue to supply Ukraine with aid. So this may help Ukraine in the short term, but in the longer term, there's big questions about where this war is going.
Roz, thank you so much, as always, for really terrific insight. Rosalind Matheson there. Now, coming up, we talk luxury, and Kering shares hit a 6-year low after a first-half profit warning as Gucci sales falter. We'll talk luxury next, and this is Bloomberg. Well, the next episode of Leaders with Lacqua is an extremely rare interview with the chief executive of Chanel, one of the most exclusive luxury brands in the world. The chief executive, Lina Nair, spent decades at Unilever before switching from the world fast-moving consumer goods to haute couture and beauty. Now, she spoke to us about the company's plans to continue investing in China and the strategy behind recent price hikes.
So we raise our prices according to the inflation that we see. So they're really linked to the cost price. We've also made a commitment to price harmonization across the world, which means our client should not experience excessive price differentials, no matter where they buy.
And how do you see the China market right now compared to the U.S. market? Because it's not that volatile, actually. You kind of have like a base that stays for quite some time.
China is a very essential market for the luxury ecosystem because of the fast adoption of luxury, because of the appreciation of refinement and sophistication. So it's a very important and essential market for us. I came back recently from China and I was really happy to see the energy and vibrancy in the market. So we continue to run our business for the long term and continue to invest in China for the long term.
And you can see that full interview with the Chanel chief executive on Leaders with Lacqua at 9:30 p.m. this evening in New York. It premieres at that time, and then tomorrow, 6:30 p.m. in London. Now on to more luxury and Kering, warning that profit will plunge in the first half of the year after wealthy shoppers curbed spending on Gucci products. Now, comparable sales at Gucci actually tumbled 18% in the first quarter on slower demand in China. Well, joining us now is Andrea Felsted from Bloomberg Opinion. Andrea, you have the pulse, of course, of the luxury world. So are other companies going to be concerned about what's happening at Gucci, or is it just a Gucci problem for Kering?
I think it's a bit of both. I think this is largely Gucci focused. Gucci burned bright for a long time and then went out of fashion, and Kering is really struggling to get that momentum back. Saying that, there are some read-across perhaps for those brands like Gucci that are in a turnaround phase, such as Burberry.
I mean, I guess the concern is that Gucci is such a high percentage of the sales for Kering. Is it similar to what Louis Vuitton is for LVMH?
Yes, indeed. It's you know, they're both key brands for the two groups, and I would say Kering is, you know, particularly dominated by Gucci. Yeah. Their other houses aren't big enough to change the fortune.
So, what's the secret sauce of being so big and still so successful? I mean, Alessandro Michele, with his vision of like opulence, and there was gold and there was velvet, and it kind of went back to the archives, did really well for a moment. And then it kind of went on to quiet luxury, and so people lost interest. How do you do that?
It doesn't matter what the prevailing look is at the time. It's all about brand desirability. If you can, you know, really encourage people to just really want the products, you know, they're prepared to eat beans on toast for a month so that they can buy that handbag. That's the secret.
So you said handbag, and I was wondering actually whether leather goods are easier to sell, especially in a downturn, than clothes.
That was always the theory, that leather goods were more resilient than other products. But I'm not sure that is still the case, given the price hikes that we've had. The theory is that, you know, products, maybe jewellery, is attractive at the moment because leather goods have gone up so much. Rather than buy a handbag, perhaps you buy a Cartier bracelet or a Van Cleef necklace. So that theory is really being tested this time round.
Andrea, as always, thank you so much for joining us. Andrea Felsted there from Bloomberg Opinion. Coming up, Boeing prepares to release earnings with analysts watching for cash outflow in the wake of its MAX 7 crisis. More on that next, and this is Bloomberg. Now, Boeing's cash outflows will be in focus when it reports earnings later today. The plane maker is engulfed in a crisis involving its main source of revenue, the 737 MAX. So for more on all of this, let's get straight to Bloomberg's Charlotte Ryan. Charlotte, so good to see you on TV. So investors, what are investors looking out for in these results?
Yeah, so in focus from the investor side, obviously the numbers. We're expecting the company to make a loss given everything that's been going on and the fact that they've had a cap on their production from the regulator, which is obviously limiting how many planes they can get out the door. On the cash burn side, they're expected to burn somewhere between 4 and 4.5 billion. So anything over that, obviously bad news. It's from the analysts I've spoken to, it's expected to be over rather than under, again, given everything going on. And then the other key thing will just be any kind of guidance about where Boeing goes from here. You know, how long do they expect that cap on production to last? Where are they in the search for the new CEO? A lot of different things going on at the moment, so there will be plenty for investors to ask them about.
What have actually regulators done so far?
Yeah, so the regulators have been pretty active on this one. I think the FAA is kind of anxious to shake off that reputation of being a bit too cosy with Boeing that they've been accused of in the past. So they've imposed this production cap that means Boeing can't go above 38 737 MAXs a month. And they've not really given any timeline for lifting that. That's kind of to be decided. And then they've also, at the end of February, given Boeing 90 days to sort out its quality control lapses. That deadline coming up at the end of May. What's not clear is what happens if they haven't sorted things by then. But there's definitely kind of a sense of a more active regulator that is stepping in with this company.
And then, I mean, is there anything that Boeing can, you know, at this point can do to address the issue. They've done quite a lot. There's a change in leadership, but not until later this year.
Yeah, so they have made some big moves. You know, they've changed the leadership. The CEO is not leaving until the end of the year, but they have already changed the head of the commercial aircraft business. And what we're hearing from airlines is that's been seen as quite a positive change. So that's something, you know, that seems to have gone well so far. But other than that, it's just about kind of showing, you know, the market, showing regulators, showing customers and people who are going to get on these planes that you're taking this seriously. You're taking steps to change things. So I think a lot of it will be about that.
Thank you so much, Charlotte Ryan, there with the very latest on Boeing. Now, don't miss our interview, actually, with the chief executive of Airbus, Guillaume Faury, tomorrow. And then in the next hour, we'll also hear from the chief executive of Ryanair, Michael O'Leary. So earnings season well underway with Meta, another magnificent 7 mega cap, due to report later today. Now, the company's generative AI tools are expected to continue strengthening its positioning. Let's get more with Bloomberg's Alex Webb. Alex, we had Tesla yesterday, and there's a lot more coming up. So what are you focused on?
Well, Meta's really interesting because the expectations actually at Meta are remarkably high. They had their year of efficiency. They have therefore reduced costs a lot. They did lay off quite a lot of people. There also seems to be a focus on their AI, not just in the generative sense, but they have a lot of people working in AI. People are realizing actually those people are often working on the ads product, and that ads product seems to be doing quite well. Excuse me, the street's looking for something like a 50% increase in operating profit and a 26% increase in revenue. That's sort of numbers that we're used to from Facebook a few years ago. People didn't necessarily think that that was going to be the case again. So there's a lot of optimism. That, of course, does mean that if there's any missing of those numbers, then they could be punished, given the way the stock has risen this year.
So who's more interesting, Meta or IBM?
I think Meta's usually more interesting, but look, IBM is interesting in a different sense because it is more sort of in the weeds of what other companies are doing in particularly AI. Like if they are taking on some of IBM's tools, helping their businesses migrate to cloud-based AI. IBM is a company that they could be using to do that. So we've seen a lot of the investment in AI tools in the cloud from the big hyperscalers, the Microsofts, Googles, Amazons of the world. There might be some indication from IBM of whether those tools are starting to be used because they hire IBM to make it happen.
What will happen to TikTok?
It's now, I mean, the jury is not quite literally, but almost literally out, because now it will come down to the courts, right? Yeah. There is going to be a big appeal from TikTok. It's largely expected to be on the basis of free speech, on First Amendment rights. It looks as though some meaningful American bodies may get behind TikTok on this, including the ACLU. That's been mooted as a potential ally in this case because they think it might be a restriction on free speech. Nonetheless, it has passed the House, it has passed the Senate, this bill, of which TikTok was just a small part, but a significant part. And now it looks as though President Biden is going to sign it into law. It'll be 270 days from that happening to ByteDance, the parent company, having to either sell or either divest or withdraw the business from the US. I think the big question is whether, if there is a court case, there will be a stay on that, or whether they'll have to do it, have to pull out defensively. I think most likely it'll be a stay, and it could be a number of years until we reach a conclusion.
Alex, thanks so much. Alex Webb with the very latest on some of these magnificent 7 companies, and of course TikTok. Now, Tesla shares jumping as much as 11% in pre-market trading. This is after what Elon Musk said yesterday. This is Bloomberg.